Edward, do you have any question?
Not at the moment.
Okay, how about Gilbert? Mr. Koros, do you have any question for me?
No, I don't have any question.
Are you able to follow from wherever you are clearly?
Yes, I'm following clearly.
Where are you watching this thing from?
I'm watching from krch.
Ah, great. Okay. I'm not able to see that. Frederick, yes. Frederick, are you
Hello.
yes?
Yes, I'm following.
Okay.
Yeah,
Are you
yeah.
in Nairobi?
No, I'm in Mombasa.
Mombasa. Ah, okay, great. You are one of our online students, eh?
Yes.
Ah, great. Thank you very much. Okay. Alex Odhiambo, yes. Any question for us regarding the question that you've just done?
No, at the moment.
Okay. Where are you following us from?
Actually, I'm following you from Nakuru.
Nakuru, okay.
Yes.
It's a game changer. Very many students in the near future will just be using this Africa School platform.
Yeah, it's a bit engaging. It really is encouraging.
Great.
Thank you.
So, a quick recap. What have we said? We've learned two things. We've learned how to get the post-acquisition EPS. Post-acquisition EPS, we have said post-acquisition, we are looking at after you've acquired this company, then we have here earnings of company 1 plus earnings of company 2. All over number of ordinary shares of company 1 plus number of ordinary shares of company 2, but now multiplied by what here? Exchange ratio. Multiplied by exchange ratio. Very, very important. The other thing that you have been made to understand this evening, I hope you are taking your summaries down there, is this formula of getting the exchange ratio. And for us to get exchange ratio, you have said the normal exchange ratio is offer price all over MPS of the predator company. The other thing which you have learned today is how to get the maximum exchange ratio, which is the same as the non-diluting exchange ratio, which we said it's equal to EPS of the target all over EPS of the predator. Somebody has learned today how to get the non-diluting offer price. So the non-diluting offer price, what did we talk about this? It is PE ratio of the predator, PE ratio of the predator times EPS of the targeted company, like that. So please allow me to go to the next question, which is question number 4. We have already done 3. So question number 4, they want us to give them A Limited's post-acquisition EPS if every 50 ordinary shares of B Limited were exchanged for a 1.8% debenture whose par value is 1,000. So the key words, A Limited's post-acquisition EPS again. So I'll start by writing the formula. That post-acquisition EPS is earnings of company 1 plus earnings of company what? 2. All over number of shares of company 1 plus number of shares of company 2, but multiplied by what here? Exchange ratio. Now this particular part is quite interesting because we have the issue of a loan being advanced to enable us to acquire the company. So whenever we give a loan, of course, we have to pay interest, and interest will reduce our earnings. However, remember that this interest is what year? Tax allowable. So it has to be interest after what year? Tax. So then the very first thing that I will do is to come and establish the total loan. The total loan. So how do we get this total loan? They have told us that for one debenture whose par value is 1,000, they shall be able to give us 50 shares. 1,000, they give us 50 shares. Now the company which you are acquiring is company B, whose ordinary shares are how many? 2 million. So then how about 2 million shares? 2 million shares. So if you cross multiply, it will be 1,000 times 2 million divided by 50, which at the end of the day will give us 1,000 times 2 million divided by 50, which gives me 40 million Kenya shillings. But I'm interested in this particular amount called the interest. The coupon rate given here, the coupon rate given is 8%. So we have here 8% of the total loan, which is 40 million. This will give me 3.2 million. So now come and substitute here. So earnings of company one, don't forget we had obtained this as not been obtained. We are given the net income is 35 plus 3 for company B minus the interest, which is 3.2 times 1 minus corporation tax. Our corporation tax is given as 30%. 30% is the same as 0.3. So 1 minus 0.3 gives me 0.7. Divide this by number of ordinary shares. Number of ordinary shares of company A, these are 10. Company B is 2, multiplied by exchange ratio, which will be 0. I would want you to understand this very well. But this exchange ratio is normally applicable whenever there is an ordinary shares exchange. Whenever there is an ordinary shares exchange. If this acquisition is either through a debenture, we are writing there that if acquisition is through a debenture, that is a loan, or preference shares, then the exchange ratio becomes automatically what? 0. This is quite important. It's something that you should even be able to write down very well, if possible, in your mother tongue, isn't it? Yeah, that if acquisition is through debentures or preference shares, then the exchange ratio equals what here? Equals 0. So please come and give us this figure. So we'll talk of 35 plus 3 minus 3.2 times 0.7 equals divided by, of course, this term here disappears when I multiply. So I'm left with divided by 10, which will give me 3 point what here? 576, like that. So that is the end of that particular question. If you allow me, I would want to take you through another one here of November 2018. November 2018, question number 4C. November 2018, question number 4C. For those of you who have already bought RCM's revision kits, RCM's books, you simply go to page number 125. You'll be able to get November 2018, question number 4C. These books are great. Please acquire them. They go for 1,100. 1,100 Kenya shillings. If you call the number of Afri School, they'll be able to organize how you're going to get these books. Afri School will deliver these books for you at 1,100. But of course, if you are away from Nairobi, you must add something small for us to deliver, the delivery charges.